Lifestyle Strategy Funds. What do we think about them? What do we think about LifeStrategy Funds, Alan?
Boo! But let's find out what we're doing. The Vanguard series of videos explaining the website, how to open ISAs and SIPPs, and one of the first funds they will offer you is the LifeStrategy Funds, keeping investing simple with a ready-made fund portfolio.
Sorry, I cut you off there.
That's okay.
All I wanted to say was that it's at the top of the list when you scan through the list of funds, when you click through and decide which one to invest in. So Vanguard are really pushing these, and we wanted to see, are they worth it? And we've already given away the answer, but we're going to show you why we came to that conclusion.
So if you look at these different bits, you've got stay on track. They monitor each LifeStrategy fund to make sure it sticks to the original balance of shares and bonds. So they're rebalancing and moving stuff around. It's diversified. Fund holds 6,000 to 20,000 shares.
And bonds?
Which sounds crazy when they say 20,000 shares and there's only 7,000 in the global all cap. So
I think
they are double counting.
Well, I think they're including bonds there, and there'll be a lot more bonds in the index than there will be shares when you have bonds in there as well. So I think that's why, but it does sound a lot, doesn't it?
Okay, and then it says, what is a LifeStrategy fund? Building and managing your own portfolio isn't for everyone. We would disagree immediately and say anyone can do it because you just pick one simple fund. That's why they created the LifeStrategy range. They combine multiple index funds. Why do you need multiple index funds?
Oh, Vanguard.
Into one fund portfolio, giving you access to thousands of shares and bonds in a single investment. This helps reduce risk by spreading your investments. Yes, but you've already got the ultimate diversity if you go for the developed world or the global all cap. You don't need any more diversity than that.
Yeah, I mean, the idea is right behind it to have a lot of diversification, but as Alan said, you can do that in one fund. So the way that this works is that they want to know how much risk you can tolerate, how risk averse you are, what your risk appetite is. You might have heard it referred to, and they do this little survey to get you to say how much you like risk. But what they confused here is risk and volatility. Volatility is how much the price of things changes over time. Stocks and shares, a feature of that is that they're crazy, but over time, and if you invest for decades, it will always go up over the long term. They've confused that with the risk of losing money. So basically the questionnaire says, do you want to lose money? Obviously, most people are going to say no to that.
It's a trick question.
So then they push you more towards bonds.
Which, if you say, I don't want to lose money, they're going to send you over to this side, which is 80% bonds, 60% bonds, and basically is slaughtering your long-term financial future.
Because you can see at the bottom here on this scale, it says lower risk, lower reward. What I would say there is lower volatility, lower reward.
Yes.
Because if you're looking at the risk of losing money over the long term, over on the right-hand side, the risk over the long term is extremely small if you are 100% in shares.
Yeah, your risk of losing money over past data, if you're 100% shares, is actually 0% over 15 years and above. So I don't understand, but that's the whole financial industry. That's not just Vanguard. They have confused risk and volatility. But beyond that, beyond the stupidity of the survey and these different funds, let's even just go for the most adventurous fund they've got over here, which is 100% shares. And we're going to have a look at this. So it's 100% equity. The charge is 0.22. Risk is 5. So it's the same risk as the FTSE Global All Cap or the FTSE Developed World. Slightly more expensive than the FTSE Developed and a similar price to the Global All Cap. Then you go down here. The fund seeks to hold investments that will pay out money increase in value through a portfolio comprised of approximately 100 shares. Great. This is the bit we don't like. The fund is actively managed.
So what this means is that they actually have passive funds within it, but someone over the top is saying which funds to invest in. So there's a human involved saying which passive funds to invest in. So there's some kind of judgment there at that point, and we don't think that's needed. We think you can just invest in one global fund. We don't think that this is necessary at all.
And then we're going to show you this bit in a bit, but the UK will generally form one of the largest single country exposures for shares, meaning it has a huge home country bias. We'll show you the percentage in a minute.
Home country bias is where people tend to invest in the country that they happen to live in. So a lot of UK investors will be heavily weighted towards the UK. We think that's a mistake. Even if the UK was doing well, which it hasn't recently, you don't want to be overly invested just in one country because you happen to live there. We think that you should invest in a global fund that invests in proportion to the size of the stock markets in the different countries. The UK is 4% of the global fund, and as we'll see, this LifeStrategy Fund has
Let's have a
way
look at the
more.
portfolio data right now. So this is the portfolio data, and you can see the number one holding is the FTSE UK All Share with 20%.
Yeah.
Then the interesting bit is they normally have a second one, the Vanguard FTSE 100, with another 5%. So we have a quarter of our money going into UK companies.
Yeah, exactly. And, you know, most people wouldn't probably know that that's UK. It's not explicit, is it? It's not clear that this is just the UK. And actually this one at the bottom is UK as well. And that's
another
an additional 0.7.
Which is really weird because the FTSE 100 and the FTSE 250 are included in the FTSE UK All Share. So you're basically buying the same company in 3 different funds.
Yeah.
It's crazy. Like, why do you even need this?
The other thing to look here as well is that they've just overly complicated this, because the FTSE Developed World ex-UK is heavily invested
like 65-70%
in the US, which is because of the dominance of the US economy. And if that were to change and other countries became more dominant, they would be replaced and it would rebalance. But as well as having this one, you've also got US Equity Index Fund, another 19%, and also the S&P 500, which is another US index, another 16%. So it's someone is picking and choosing which countries basically that you should be invested in. And we think this is completely inappropriate, Vanguard. You just need the one global index fund and it will all sort itself out for you. If one country, as I said, starts to become more dominant, starts to be more successful, that will make up more of the index. There's no need to have this overlay of someone choosing which index funds beneath it to be invested in.
And the 500 companies in the S&P 500 are also in the US Equity Index and in the FTSE Developed World. So you're buying those 500 companies 3 times in different places.
It's crazy.
It's just madness. Then let's look, obviously we need to get down to the brass tacks, the actual cash. Let's look at price and performance. So you've got the prices, price analysis, past performance, and the bit we tend to look at, past performance on a lump sum because it makes it easy to understand. So if you invested for 5 years, you would have put 10 grand in at the start and it would be worth a whopping 14,200 after 5 years. And you've got to realise this is the most adventurous fund they do. The other funds will have all performed worse than this because they are in bonds. So 14,200. And if you compare that to the simple FTSE, is this the developed world?
Yes,
isn't
it is. So we're just going to compare. So again, 10 grand invested in July 2018. 5 years later, July 23, just under £16,000.
So you've kind of lost £1,700-1,800 has vanished, which is a huge amount on a 10 grand investment.
Exactly, and this one is just one simple way of investing in the developed world ex-UK, because that's one of the most global funds that Vanguard offers.
And if we go back to that main page and choose a different fund, so this is back to the LifeStrategy products, which is just loading. Let's have a look at those. So if we went back to the LifeStrategy 20% fund, let's look at the full fund details. So this is way more bonds, and we compare that price and performance over 5 years. Let's have a look. Price and performance, 5 years, 10 grand invested. You would actually have £10,200 after 5 years. So you would have made, what's that, 0.02%?
The irony here is that they put people that are worried about losing money into funds that will reduce the volatility but sacrifice the return as well, and they kind of get what they're afraid of there.
They're guaranteeing losses.
Yes.
Because if you took that, your 10 grand 5 years ago, the buying power of that 10 grand today is less. So you've actually lost money to inflation being invested in this fund. Like, they literally shouldn't be allowed to offer this to people. It is crazy. You destroy your financial future through this stuff.
So shall we wrap this up and summarise what we think about the LifeStrategy Funds?
I think people know.
I think you can tell we're not big fans of this. It's one of the first lots of funds that Vanguard recommends at the top not recommends, but puts right at the top of their list of funds. You have to scroll past it to get to the simple one index fund that we think is the right way to go. So we would say no, avoid this, avoid the target retirement funds as well, which we've done a separate video about. Check that one out too.
Yes, number one, you don't need bonds if you're in your earning years. Number two, it has heavy home country bias. And number three, it doesn't perform well as the other funds. Just avoid. So thanks for tuning in to our series of Vanguard videos. We have lots of other videos we've done for you, how to open a SIPP, how to open an ISA, a guide to the different funds. So check out those links below, and we really appreciate you being here. If none of this made sense, come to Rebel Finance School.